You're listening to the Financial Source Podcast, your daily dose of sentiment updates in the European and U.S. sessions and critical risk event previews so you stay up to date with what's moving the market right now. Each session is carefully crafted personally by the Financial Source analysts and voiced by our AI hosts who, as it turns out, sound a lot better than we do. Here's Rachel and Michael with this session's deep dive.
Welcome back to the Deep Dive. Today, we're tackling a really, frankly, absurd situation impacting global finance.
Absurd is a good word for it.
We've got this U.S. government shutdown creating a huge information vacuum, and it's crashing right into, already complex geopolitics and jumpy commodity markets. Our sources today, quite a stack here on market moves, policy shifts, risk analysis. They're basically our map.
Right.
And our mission really is to try and make sense of the noise, figure out how global traders are pricing risk when they can't even see the fundamental U.S. economic data.
And that information vacuum you mentioned, that's absolutely the key thing right now. It's a complete paradox.
Thought so.
Well, on one hand, you've got all this headline chaos, the shutdown itself, but financially speaking, the main guardrails seem to be holding.
Okay.
You see that reflected in Fitch's assessment. They came out and confirmed, look, this shutdown, no near-term implications for the U.S.'s A plus credit rating for now.
Okay, so the big rating agencies aren't hitting the panic button.
Yeah.
That removes maybe an immediate systemic threat.
Exactly. But that doesn't mean there's no cost. We know it's real.
Right.
S&P, for instance, they estimate the growth hit is already building up. It's knocking off maybe 1 to 2/10 of a percentage point of GDP.
Per week.
Per week. Okay, that adds up quick.
It does.
Yeah.
But the real existential problem for traders, it isn't just the gridlock itself. It's the fact that those critical economic reports, especially things like the jobs report, they're delayed.
Yeah.
So the Federal Reserve and, by extension, the whole world is basically flying blind.
Okay, let's unpack that. If the market sort of knows growth is slowing even a bit, and there's political chaos, why hasn't the dollar just, collapsed?
Yeah.
The dollar index has been weirdly resilient, right?
Yeah.
Holding in a pretty tight band. Isn't that short-sighted? Shouldn't they be pricing in those delayed GDP hits now?
It sounds short-sighted, I get that, but the mechanism is actually pretty logical if you think about it.
Okay.
Traders aren't dumping the dollar because they fear the Fed's blind and might mess up later. They're just, paralyzed.
Paralyzed. Reduced data visibility means reduced conviction. You can't make big, aggressive bets. The uncertainty about when the Fed will finally see those delayed labor numbers and, frankly, how bad they might be, it just creates this temporary sort of pricing vacuum for the dollar. So it's holding steady, just waiting for the smoke to clear, essentially.
A holding pattern for the world's reserve currency. That's quite something.
Yeah.
What about the other big currencies? Especially in Europe, they must be watching the U.S. situation closely.
Yeah, they are. But the European majors are largely quiet, almost like they're waiting for the U.S. to sort itself out first.
Okay.
The euro, for instance, it stayed pretty comfortably above 1.17 sterling. It consolidated some recent gains, traded within those technical guideposts. Analysts watch the moving averages.
Right.
Basically, there just wasn't enough fresh regional news over there to override this global paralysis coming out of Washington.
And usually when uncertainty spikes, people look to the Japanese yen, right? The safe haven. What happened there?
See, that's where you really see the tension bubble up. Dollar yen was choppy, specifically bouncing around the high 147s.
Okay.
Because you've got these two huge forces pulling against each other. On one side, genuine safe haven demand, which should boost the yen.
Right.
But battling against that is the Bank of Japan's own very cautious, very data-dependent stance on its own policy. The market just hasn't figured out which force wins yet, so it's just bouncing.
Back and forth. Okay, let's pivot to Asia then. Specifically, maybe the Antipodeans and the Korean one. For listeners, Antipodeans usually means the Aussie and Kiwi dollars together.
Exactly. The Australian dollar, the AUD, it was pretty subdued. And that's even though overall risk sentiment actually felt okay across Asia. The sources are pretty clear on why. China's Golden Week holiday just thins out liquidity. Big institutional trades are paused. Less activity means the AUD stays in check.
Makes sense. And the Kiwi.
The New Zealand dollar, by contrast, it actually edged a little higher, but into a pretty quiet local calendar. Not much happening there domestically.
But the really interesting forward-looking bit came out of Seoul, right?
Well,
About the Korean one.
It did, yes. And this is a really critical link for anyone watching trade dynamics going forward.
What was it?
A Bank of Korea official basically noted that the negative hit to exports from those U.S. tariffs, well, it hasn't really bitten hard yet, materially anyway.
Okay, yeah.
Yet. That's the key word. Because they also said they expect that impact to show up much more clearly next year.
Ah, okay.
So that's a clear marker for KRW watchers. It tells you the market is starting to price in this delayed pain from policies already in place. It gives you a sort of calendar date for when U.S. trade policy effects might really hit Asian export numbers.
Wow. That really highlights the data vacuum issue, doesn't it? We're not just missing current data, we're also waiting for these lagged policy impacts to finally crystallize.
Exactly.
Okay, since the shutdown has, blinded us to key labor and consumer data, let's shift to commodities. Pricing pressures there are often more immediate, right?
Yeah.
Regardless of delayed reports. Let's start with oil.
Right. So crude oil prices stabilized somewhat, but they remained pretty soft after a slide earlier in the week.
Okay.
And to really understand the competitive vibe there, you actually have to look beyond just the crude price itself. Look at refined products.
Like gasoline, diesel.
Exactly. And the key signal there came from Saudi Aramco. They made deeper than expected cuts to their LPG benchmark prices, that's liquefied petroleum gas.
Deeper cuts.
What does that tell us?
It's a strong signal of competitive pressure, suggests demand isn't exactly roaring back, and producers are really fighting for market share in those downstream products.
Okay, so maybe a sign of softer global energy demand dynamics, or at least, fierce competition for what demand there is. What about supply? Where's the focus there?
Well, North American logistics are always under the microscope.
Uh-huh.
Traders are keeping a close eye on very early-stage planning for a potential new Canadian crude pipeline corridor aimed towards the Pacific Northwest.
Another pipeline project. Yeah. If that actually gains real momentum, it could fundamentally change the flow and maybe the pricing power of Canadian heavy crude. Something to watch long term.
Got it. Okay, shifting gears to precious metals. Gold. The traditional beneficiary when things get chaotic, it seems to be doing well, hovering near recent records.
Thriving is probably the word. Gold is the ultimate hedge when the market is flying blind like this.
Why the strong bid now?
It's really a trifecta. You've got the softer dollar, even if it's just stable for now. You got the delayed U.S. data, meaning nobody really trusts what the true state of the economy is. And then layer on top that persistent geopolitical tension.
Right.
We even saw a prominent bank reiterate what they call high conviction upside for gold over the medium term.
High conviction upside. Banks don't usually use language like that lightly.
Exactly. It tells you the so-called smart money sees gold as absolutely essential insurance against pretty much every risk we've just talked about.
Chaos is good for gold, as they say. What about copper, though? That usually needs strong industrial demand signals, which we don't really have clearly right now because of the data issue.
That's the interesting part. Copper has actually firmed up. It's holding above that really key psychological marker of $10,000 per ton.
Even with China on holiday. They're a huge consumer.
Even with China quiet. It shows the market's focus right now isn't so much on current demand, which is murky anyway. It's on future supply fragility.
Supply risk? Where from?
Specifically, worries about potential disruptions in major mining regions. Think Chile, Indonesia.
Can you give an example? Like, what triggers that worry?
Yeah, absolutely. Just recently, there was a localized fire reported at Glencore's Lomas Bayas copper operations in Chile.
Okay. Was it major?
Apparently not huge. They said crews were handling it, operations continued, but the market's reaction, that sensitivity to even a small localized fire, it just underscores how paranoid traders are about supply stability right now.
So any little hiccup gets magnified.
Precisely. The concern is that any small friction point could snowball into a major production shortfall down the road, and they're pricing that supply paranoia in right now, even without clear demand signals.
That detail really brings it home.
Yeah.
Okay, let's move now to that very high-stakes area where trade policy meets geopolitics, where threats and tariffs become, well, leverage. Domestically, there was some news on pharmaceutical tariffs.
Absolutely. This is a fascinating example. The White House had been threatening these, frankly, huge triple-digit tariffs on branded drug imports.
Right, I remember that.
But implementation of those new tariffs, it's been paused for now. And that pause comes while existing price negotiations are still going on.
So the threat was the point.
The market reads it that way, yes. The threat of the tariff was likely tactical leverage. a tool to try and extract concessions on drug pricing rather than an immediate fundamental shift in trade policy itself.
And we're seeing that same kind of dynamic, that political leverage, play out with agriculture in China too, aren't we?
Exactly the same playbook, really. Soybean farmers are feeling the squeeze because China is deliberately holding back on purchases.
Why?
Again, using it as negotiating leverage. There's a planned meeting between the leaders, probably in about 4 weeks or so. Agriculture is expected to be a major topic.
And how are the farmers coping?
Well, to cushion those domestic producers from the fallout of this trade spat, the U.S. government is actually tapping into existing tariff revenues.
Using tariff money to pay off the people hurt by the tariffs.
It's an explicit policy-driven move, using trade income to manage the domestic political costs of the trade dispute itself.
Okay, looking bigger picture now. It's not just the U.S. using trade as a weapon, right? The G7 seems to be doing it too.
Oh, absolutely. And what's really striking is how globalized this weaponization of policy has become.
How so?
The G7 specifically emphasized using trade measures, things like tariffs, import bans, export bans, explicitly to limit Russian government revenue.
To hurt their war effort.
Precisely. It just unequivocally hammers home that link between geopolitics and cross-border financial flows. It's all connected.
Any other diplomatic fallout from the shutdown?
Well, separately, we're hearing that preparations for a broader U.S. diplomatic swing through Asia have slowed down, likely because key personnel are affected by the shutdown. Though, interestingly, South Korea did signal that a basic security framework with the U.S. is largely agreed upon already.
Okay, let's carve out some time now for the pure geopolitical flashpoints. These are the headlines that constantly flicker in the background, shaping risk premia, totally separate from the U.S. data calendar. Ukraine, obviously, is top of mind.
Yeah, and the operational tempo of that conflict looks like it might be shifting significantly.
In what way?
The United States is signaling a pretty major potential escalation. They're saying they'll provide Ukraine with intelligence support for long-range strikes inside Russia itself.
Inside Russia, wow.
Yes. And they're actively encouraging NATO allies to do the same. For the market, that translates immediately into higher conflict risk premia. It could really alter the whole dynamic of the war. And, the risk of miscalculation goes way up.
And tied into that, especially for European energy security, is the ongoing risk at the Zaporizhia nuclear plant. Still critical.
Extremely critical. Kyiv issued another quite dire warning. They said the situation at the plant is critical because the constant shelling is messing with the power supply. Those external power lines are just unstable.
And the IAEA.
The International Atomic Energy Agency, they're actively engaging both sides, trying desperately to get that reliable off-site power restored. It's just this constant nagging reminder of a physical risk that could instantly blow up European energy prices and global anxiety.
An unquantifiable risk, really.
Absolutely. But it's baked into every European gas contract right now.
Okay, moving away from Europe. Maritime security, Middle East risks.
Yeah.
Those haven't gone away either.
Not at all. Maritime security is still very tense, and that directly hits things like insurance costs, logistics costs, globally.
Any specific incidents?
Yeah, Yemen's Houthis claimed another attack this time, a cruise missile strike on a Dutch-flagged merchant vessel. That keeps shippers and insurers on edge in those crucial Red Sea shipping lanes.
And Iran. Always a factor.
Always. We're watching Iranian messaging closely. Tehran recently flagged a potential expansion of its missile range, specifically if European pressure on them increases.
How does the market read that?
Through the lens of regional risk premia. Specifically, how stable are oil logistics through the Strait of Hormuz? Any threat there immediately impacts global oil prices.
Wow. This whole deep dive.
Yeah.
It feels like watching this incredibly complex machine trying to operate, but someone's just slapped tape over all its main sensors.
That is the perfect analogy, actually. If we try to synthesize this whole messy picture, what defines the global market right now is that restrained dollar trade. Why? Purely because the shutdown killed the data visibility. Simple as that. Precious metals. Clearly supported by hedging demand. That tells you there's pervasive anxiety among institutions.
Right.
Oil. Still trying to find its footing, softened by that competitive pressure we saw in the Saudi product price cuts, plus all the macro uncertainty.
And underneath it all.
And underneath all that, you've just got this steady drip, drip, drip of headlines about escalating geopolitical conflict and weaponized tariffs. And that shapes all the cross-border flows.
What really stands out to me in this whole convergence is it just highlights how incredibly quickly a purely domestic political event like this U.S. government shutdown cascades into global risk calculations.
Mm-hmm.
It affects everything from, how a farmer in Iowa gets paid potentially to the price of copper traded in London. The entire world is basically waiting for Washington to flick the lights back on.
It's a really remarkable demonstration of those market linkages, isn't it? It shows just how much stability itself is a global commodity.
Absolutely. And if I zoom out even further, everything we've talked about seems to circle back to that one massive hole, that gap in the U.S. data calendar.
Yeah.
The uncertainty about the Fed, the dollar's weird stability, the strong bid for gold.
Yeah.
It's all tied to that missing information. So maybe here's the final thought we leave you with.
Okay.
How much hidden economic pressure might be building up globally? Unseen, unmeasured by traders, by regulators, by the Fed itself. Building up before the shutdown finally ends and reveals the true state of U.S. labor, U.S. demand. That unseen pressure and the reckoning that might follow when the data finally comes out, that feels like the key development to watch now.
Indeed. That silent buildup of risk. Definitely something to mull over.
Well, thanks for diving deep with us into this slightly crazy situation. We'll get you next time.
Thanks for listening to the Financial Source podcast. If this podcast helped you at all today, would you consider leaving us a review to help spread the word? Each month, we also give away different resources and indicators just to podcast listeners. So write into Financial Source at support@financialsource.co to claim your free gift today. Talk to you all in the next episode.